The Federal Reserve just did it again. They raised interest rates to 5.5%, which officially is the highest rates have ever been in the last 22 years. So, what I want to do in this video is I want to talk about it, and then I want to tell you what it means for you and your money and the overall economy. As always, my name is Derek, and I got my degree in finance, so you don't have to. Let's talk about it. So, today, officially, the Fed has raised interest rates to 5.5%. That is a 0.25% increase. They had paused raising rates last meeting. So this is a continuation of their previous policy to fight inflation. Now, according to the Fed, the reason that this was done is, of course, to fight inflation, which tells us a couple of things. It tells us, one, that inflation is not where the Fed wants it. Remember, the Fed has a target rate, what's known as a target rate. And this is basically the rate that the Fed wants inflation to be at, because inflation is not inherently bad or good. Inflation just is. And if we want a functioning economy, an economy that continually grows, we do need some inflation. If you have deflation, a lot of times it'll cause economic shrinkage. So if you want companies to have the ability to charge more money, which in turn leads to higher profits, which in turn leads to a higher stock market, which in turn hasn't always, but it should lead to higher salaries. You need some inflation, right? You need something to push the economy forward. So the Fed wants some inflation. The problem is when inflation gets out of hand, like it has been for the last year and a half, when it's pushing 6 or 7%. So their policy tells us something. It tells us that the fight against inflation is not over yet, and inflation is not at the levels that they want it to be. Now, this by itself has implications for the overall market, anywhere from the stock market to salaries to the real estate market. That alone has implications. The other thing that has implications, not just the inflation part, but the interest rate itself, the interest rate increase has implications that will affect the markets, or at least should affect the markets. And why I say that is because one of the major markets that is supposed to be the most sensitive to rate changes is the real estate market. And that is the one market that seems to not budge. So we're going to talk about that. Let's cover what exactly this means immediately, like tomorrow. Well, what it means is, one, in most cases, you would see it affect the stock market, even today. That I don't think is going to necessarily happen over the next few days, 2 weeks. And the reason for that is because a rate increase was probably already priced into the market. You see, last time, Powell said that this pause, because last time they paused rate increases, Powell said that that was not a change in policy. What it was a pause to see how inflation was doing, and that most likely through the end of 2023, we were going to see further rate increases, which is exactly what we've seen. So the market knew ahead of time that there was most likely going to be a rate change, and that it most likely was not going to be a 0.50, a 0.5% increase like it had been in the past. It was most likely going to be a 0.25 increase, which is what it was. So on that side, on the stock market side, probably no major change in the next coming days, 2 weeks. What I also want to focus on is real estate, because real estate is supposed to be the most sensitive to rate changes. Why? Well, rate changes, the federal funds rate, directly affects bank mortgage rates. Okay, so when you go try to buy a house, your mortgage rate is directly affected by whatever the federal funds rate is. That's why back in the 80s, when the federal funds rate was super high, so were mortgages. Okay, the problem is that in this scenario, and this is why financial theory is so funny, because financial theory tells us that if rates go up, demand for houses are going to go down. And that also means that house prices should come down to meet demand. The problem in this scenario is that supply almost goes down instead of up, because rates lock people into their houses. The fact of the matter is that something like 99% of every single mortgage borrower has a rate under 6%. A lot of them have rates way down in the 2.5% to 3% range. So all those people that in any other scenario, when housing prices is going up, in any other scenario, those people would want to move up market, right? Because as you progress through your career, you want to buy a nicer house, a bigger house, etc. So Any other time, those people are going to move up market. The problem is right now, because their rate is so different than the rate that is currently, which is above 7%, they cannot move because literally, even if they had a ton of equity in their house, the next house that they bought, if they bought up market, right? So a more expensive house, a nicer house, a house with a pool, that house is going to cost them more money solely because the rate is so much higher. In fact, in a lot of instances, even if they moved down market, even if they bought a house $50,000 or $100,000 less than their current house, they're going to pay more because interest rates are so much higher. So in this scenario, right now, because of because there's not enough housing supply, which has to do with them, also has to do with builders not building. There's been a housing shortage for the last 2 or 3 years. Until that changes, these increases in rates, while they should affect home prices, they should bring home prices down, they're not, because those people are not budging. And in fact, in some estimations, it's actually making things worse, because the higher the interest rate goes, those people get more and more locked into their house because they become more and more sensitive to an interest rate change. All right, so that's something to take into account. In any other scenario, that would cause most likely a drop in real estate demand, which should lower the prices, right? Because lower demand or higher supply, either or, causes a move down in prices, and vice versa. So stock markets, probably not a major change. You're probably not going to see too much besides the normal panicking that the average investor does, because as we know, the average investor is a pussy. But for most, when we talk a week, 2 weeks, 3 weeks out, probably not much change because this was already priced in. Okay, so besides the 1 or 2, people who are going to freak out and panic, probably not a long-term change. On the flip side, when we look at it long-term, if we look at it long-term, 6 months out, a year out, we need interest rates to eventually come down, because if we want to get to if we want to get the economy churning again, and we want to get the economy moving and growing, you need money, because businesses need funding, and that funding takes better place, or is more easily achieved at a lower rate. So we need rates to come down if we want to get this economic machine chugging along. The thing is, interest rates, again, just like inflation, interest rates by themselves are not inherently good or bad. They just are. And the Fed looks at them as such. The Fed does not necessarily look at rates as good or bad. They just look at rates as a tool to control the main thing that the Fed is responsible for controlling. They're responsible for controlling economic growth and shrinkage, but they're also very concerned with monetary policy that affects inflation. So the Fed is going to focus their efforts on that above all else, especially right now that inflation is not where they want it. So the Fed will raise rates, and the market, the economy, and in most instances, real estate becomes collateral damage. And even in this case, because real estate prices are going up when people can't afford houses. So those become collateral damage, acceptable collateral damage, according to the Fed. When you look at their policies, because their main focus right now is fixing inflation. So interest rates just exist. They're neither bad nor good. They're a tool to accomplish what the Fed wants to accomplish. Right now, it is inflation control. So the stock market, if we look out a year or 2 years, and a lot of us are seeing good things coming for stocks, right? Corporate profits should go up if inflation comes down. Stock markets should continue to rise if we avoid what? If we avoid a recession, and if we avoid sticky inflation. If we can avoid those things, stock prices should probably move up. The problem is, this meeting that the Fed had kind of signals to us that inflation is stickier than we would like it to be. When we say sticky inflation, we mean inflation that does not tend to budge. As the Fed controls policy and restricts money supply to try to bring inflation down, okay, there comes a point where inflation may become sticky. 7%, 6%, 5%, let's say 4%, right? 4% inflation does not want to budge. What is the Fed going to do? They're going to, again, restrict money supply to try to break through that level. And that's exactly what you're seeing happen right now, is they want inflation lower. They don't want sticky inflation to last, right? What did the Fed say in 2022? That inflation is transitory. And most people are, using that as a tagline, like, oh, look what the Fed said, and it's not true. I don't know if it's not true. I think inflation is just proving to be a little bit more difficult to deal with than expected, because you have the banking crisis too a few months ago. There are so many things that the Fed cannot foresee because we look at these people as like they should know everything. But in reality, the Fed is run by people, people like you and I. Okay, so people make mistakes. People cannot foresee everything, and I'm not cutting them slack. I'm just saying people cannot predict every little thing. So there have been issues that they have had to divert, pause, etc., on their fight against inflation, like the banking crisis. And inflation seems to be a little stickier than once expected. So until inflation gets down to where the Fed wants it, we're going to have higher rates. And until higher rates come down, things like home building, things like a boost in economy, things that we need to get back on track to have the market move up, to have economic growth, those things are going to not be as easily achieved until rates come down. It's hilarious that the Fed has so much power to move things in one direction or the other simply by what to you or I might look like a very simple thing, interest rates. But interest rates affect everything that we do in the economy, literally, from savings accounts to mortgage rates to car rates. They affect everything. And it is the way that the Fed opens or closes the floodgates for economic growth, or on the other side, inflation control with the risk of economic shrinkage, also known as recession. So my thoughts on all of this and what it means for you or I. This was already priced in, okay? So no need to panic. Unless you've been living under a rock, this was already priced in, okay? So stock markets are going to keep chugging along most likely unless we get some severely bad news where inflation is really not moving down. Two, while in any other scenario this should affect home prices positively for you or I, it's not, because it is just further locking people into their homes. Okay. Not only that, it is continuing to make borrowing expensive. What that does is not only does it make borrowing expensive for you or I if we try to get a mortgage, it makes borrowing expensive for everybody. That includes home builders. And until we get a boom in starter homes, the home market is going to be jacked up because there are not enough supply. One of the largest waves in history of potential home buyers, which is millennials moving into their mid-30s, which is when the average age of home buying takes place, there's not enough homes for those people. So until we get a boom in home building, that's going to be an issue. And that is only exacerbated by the fact that interest rates right now are so high and they're not going down yet. So through 2023, we're going to have high interest rates. Hopefully in 2024, things will change. And then moving a year out, like the back end of 2024 into 2025, that's when maybe interest rates are going to be coming down to a level where inflation is taken care of and rates for home buying can come back to earth, basically. And I don't think home interest rates, mortgage interest rates, I don't think we're going to be at the sub 3% anytime in the future. But I do think at the end of like 2024, we can maybe start to see rates come down to 4%, the mid 4s, low 4%. Remember, right now they're at 7%. So 4% sounds high if we were around in 2021 when rates were like 2.25%, 2.5%, right? A little bit more than that, 2.5, 2.6%. But looking at it compared to today's rates, that reduction from above 7% down to 4%, that's a huge difference. That is a huge difference. From 7% to about 4% is a huge difference, and that alone will hopefully cause a boom in the housing market, a boom in the buying market, and hopefully it'll allow those people in the upper end of the market who are holding on to their houses because they literally don't have a choice. Hopefully they will start buying and looking for upmarket homes, right? Which will allow that mid category of homes, $400,000 to $500,000, which are more like upper mid category of homes, especially in California, to kind of flood the market, which will allow more supply. So literally everything hinges on inflation. And everything hinges on inflation because until inflation is taken care of, interest rates can't come down. And if interest rates can't come down, all these things that we expect the market to do, which would be positive for the market, aren't going to happen. So We need to get rid of inflation, and then we need to bring interest rates down, and then hopefully supply chain issues figure themselves out, and all those other things kind of sort themselves out. But all this is lying on one thing happening, and that's inflation coming down and then interest rates following. So yeah, that's kind of what needs to happen. I hope you enjoyed this video. I kind of just shot this one take. Let me know what you think of this, as opposed to my other content, which is more edited. This is basically unedited. So let me know in the comments if you like this style, if you like the more edited style, or maybe a mix of both. Maybe some edited videos and some videos just me shooting from the hip, on the fly. But as always, my name is Derek, and I got my degree in finance, so you don't have to. If you like personal finance, if you like economics, and if you like topics like this, broken down in simple terms, you're in the right place, because that's all we do here. It's been my passion for over a decade, and I have a lot of experience both as an entrepreneur, as a real estate agent, and basically just investing my entire net worth in the stock market for the last decade or so. So I love this stuff. I love sharing it with you guys, and I hope to see you in the next video. Take care.